Okay, good afternoon, everyone. Welcome. We're excited you could be here today with us again for our monthly small business webinar, where we bring you topics that are relevant to new and growing businesses to help you get a step ahead. We're excited you could be here today. Actually, today's topic seems to have hit a nerve because we had a tremendous amount of registration come in for this webinar. As always, these webinars are recorded and we will send out a link for you to view the recording once it is available. Before we begin the webinar and before I introduce today's uh, teacher of today's webinar, I would like to first welcome one of our most important programs here at CHYE is our business mentorship. We help entrepreneurs connect to mentors for one-on-one business advice. We have our lead mentor, our senior mentor, Kasriel Shemtov, who meets everybody, and then either he helps them or he connects them to our vast network of mentors. Kasriel, are you here?
Right here. Hi, everybody.
Okay. Hello, everyone. This is Kasriel Shemtov. He sits here in CHYE and he dishes out amazing business advice to anyone running a business or launching a business, and he'd love to meet with you. Free service. You can just go onto our website chye.info, and you could click on the mentorship form to fill it out, and Kasriel will respond to you. Kasriel has been with us now for a year, and he has helped launch tens of businesses. He's helped tens of businesses grow and restructure, and it's exciting to have him here. Kasriel, you have anything you want to say?
Just consider me Katsas Yedid. I will be your friend and help you and advise you as a true friend.
Awesome. Thank you very much. And so again, if anybody is looking for business mentorship, click on chy.info forward slash mentors, or just chy.info and fill out the mentorship form. Thank you, Kasriel. Okay, so today's topic, an important topic. If you're you're an entrepreneur and you're starting your own business, how do you pay yourself from your business? This is very important. And so we've had the good fortune. Yitzchok Eilenberg, CPA, is the up and coming CPA in Crown Heights, and he has a special forte in this topic, and so he's going to teach. He's going to be about a 20 to 25-minute presentation followed by Q&A. Okay, so if anyone has questions, if they're critical, put them in the chat. Otherwise, hold them towards the end, and we'll take it from there. So Yitzchok, the floor is yours.
Hello and welcome everyone. Thank you very much for joining and doing this for yourself, for your business, and building your generational wealth. And you made a very good and informed decision to be here. And I will see to it that none of you should regret it and that your attendance is very valuable to me. I do see in the crowd that there's, people who have spoken to before or seen their names. So thank you for as well joining. And I wanted to start off by breaking down what we're going to cover, like the format of this, so like you know what to expect. So in case you need to drop off, before it ends, you'll have like some sort of core idea of, what is still to come. So it's going to be like 30, 40 minutes. I know that I'll be sure I'll mention 25 minutes. So we'll cover more important topics sooner than later. And as we go along, there'll be less crucial topics. And Yeshua said that there's going to be a recording. So afterwards, I'm sure he's going to send that out as well. So in case any of you want to drop off earlier, you can pick it up in the recording afterwards. If anyone wants to share in the comments where you're joining from, I'd of course love to hear and see, if you want to add that. So I'm going to start off with just introducing myself, saying who I am, what I do, who I focus on helping. So as mentioned, I'm a CPA. My name is Yitzchok Eilenberg, doing this now for around 9 years, experience in accounting and taxes. And currently I specifically focus on businesses or clients who are structured as businesses, either of the two, that make enough that will, come across when filing taxes that they're going to have a very large tax bill, and They're looking for ways to navigate it, legally in a way that's structurally sound and least audit, to be picked on by doing things in ways that are aggressive or look wrong when filing your taxes. And they need guidance on that. And every strategy that we could employ for them saves them tremendously, and this is what these clients are hungry for. And without these strategies, I've seen some of these clients that came, the newer ones, before they started working with me. They were just working with a regular CPA, just some tax preparer beforehand, and they were paying $35,000 extra or whatever. Actually, just yesterday, I had this one client that, when we're all said and done, $95,000 refund between IRS and the states. And the reason why is because, and they're filing single with no dependents. So it's like, wait, usually, a recipe for a refund is married. And so the reason why is because the prior accountant had them just overpay estimates because they didn't have any, per se, strategy to employ for them. So to be on the safe side and not let the client down with a $100,000 tax bill year end, he said, pay in $100K. So we're able to get him back what, plus a bit more what he overpaid. So that's the point of, who I target and how I like to help each and every one of my clients. And that's what I told him. I told each and every one of the clients gets that type of service because that's what the clients are looking for. They're looking for ways how to mitigate your tax bill. And that's really the core of today's topic because, the way you pay yourself really could influence on these matters. And there's going to be several levels as your business grows. And we're going to take it one level at a time, starting from grounds up and going to the more intense, larger of the structures that, you could eventually employ as you grow into that level. So the first step would be somebody who's just starting out their business, they're a sole proprietor, or they have an LLC or not, whatever it is, they're doing sales, they're making money, and they're ready to take money out for themselves personally, right? And that's when they start questioning themselves. Do they need to put themselves on a W-2? Are they going to 1099 themselves? Can I just swipe it out of my business? What's the story over here? Right? So if a person is still on that simple level where they're a sole proprietor or they are a single member LLC, they would not go on a W-2 and they would not 1099 themselves year end. So they would either just simply transfer over the money from their business to their personal and spend it over there. But first, what I'd like to tell people is before you just run ahead and do that, let's think, well, what could be justified as a business expense? Your spouse's cell phone, your home internet, your car, to what percentage? Home office, and there's a lot that we cover. So then we have to discuss what should be transacted out of your business instead of your personal, and what should remain in the personal, just transfer it over first. Like the mortgage, for example, would say it's majority personal. So we wouldn't say pay the whole mortgage out of the business, right? We would say you would make an individual transfer and you'll put the note over there that resembles the home office. But if it's majority business or fully business, right, then that could potentially be transacted out of the business account directly, leaving you with a very low net income. Because this is another thing that people are wondering is when you pay yourself, it's the whole idea is like you want to know if I'm paying myself and I pay taxes on it. But if you're paying yourself as a write-off because you think they're justifiable, ordinary, necessary business expenses, then there's no tax on that dollars that you're spending. Had you taken a W-2 job, gotten paid after tax withholdings, and then go pay your cell phone bill, sorry, you're not getting your tax back. The IRS is not giving it back to you. That's another reason why I have all my clients get off W-2 as quickly or as much as possible, unless there's a specific strategy to it, like you're in S-Corp, which we'll talk about later, Or, sometimes there's certain benefits that they get through W-2s. It's a whole separate conversation, not for this webinar. But this is basically, the first level of strategy, the beginner. Get into your business the transactions that can qualify as a write-off and keep it over there. Then will come the next level, right? Let's just say a person is making too much that even after all these spend anyway write-offs, we'll call them spend anyway write-offs, all of that is transacted out of your business. Hopefully you get down to a zero net income. So long you're a new business and your income is still on the lower end, fine. But once you grow, you're still going to be left with a sizable chunk on the bottom of the bucket. And then that becomes a question. Well, what's going to happen then? So if you remain a single member LLC or a sole proprietor, problems begin to happen. Not only is that chunk left over, which is going to continue growing, subject to income tax, federal, state, on the incremental growing basis, but also to a 15.3% payroll tax or self-employment tax, same idea. So on $50,000 net income, 50K, that's like $7,500, and it grows the more that amount grows. So that's a really ugly tax that we try to. There's legal ways to avoid that tax with better structures that cost way less to implement and employ than the tax would be. So that's when we start to get more creative over there. So usually that break point would be around 50K. When a person nets 50K is when I'm going to tell them now it's time to consider for you to evolve. Another break point would be if your income is way too high, even if your net is too low, I may have a client want to switch over, but that's not the subject for today as well. The point over here is that if your net income is getting larger and larger, for that alone is a justification to get off of just filing it as a sole proprietor or single member LLC. So that's, and by the way, the same strategy would go as well for a multi-member partnership, right? So we talked about an LLC that's a single member. Let's say you have a partner. So you structure your LLC to be multi-member, right? In the business, you're going to only put what's truly associated to the business. Because if you're going to start putting your personal expenses into the business, you're starting to share on a percentage basis with your partner what's truly yours. You have a Lexus, they have a Hyundai. You don't want to give half of your Lexus to the partner who's a 50% partner and take in return half of his Hyundai. So that's when you have to be more strategic with multi-layering the entities within your business so that your portion comes to your business where you get to take your write-offs and their portion comes to their business and they take off their write-offs, right? There's also ways to accelerate and take even more write-offs than just the general ideas that we talked about with ideas like kids on payroll and things like that. And that's a whole subject that could take a webinar on its own. But on the partnership level, you're going to put what's truly associated to the partners. That would be your QuickBooks subscription, anything that has to do for the partnership itself. And then each portion of yours will come on the K1 to your personal business, LLC, S Corp, whatever makes sense in that partner situation. Then once they take over from the multi-member partnership, you don't take a W-2. There's something called guaranteed payments where a partner takes like a certain, guaranteed payment, but it's the same idea as a W-2. So try and stay away from it or take it with serious consideration and consultation with your accountant if guaranteed payment is right for you to what amount, because it's basically taking a W-2, just calling it something else, and it comes in a different form, but it's the same tax ramifications. So that is something you want to be cautious about as well, not just take guaranteed payments out of the partnership. You want to take more income, funnel it through your business. on the second layer, meaning from the partnership to your business on the K1, and then there you take your write-offs. If you're an S corp, that's going to be the next, subject we'll talk about. So as your income grows and that self-employment bucket continues to grow, like we just mentioned, that will happen at 15.3%. At that point, you want to evaluate what should you do next. In some cases, it could be to open up an S corp. Sorry, I noticed I haven't been switching the webinar thing over here. Let me see where we're holding. See, this is what we mentioned, that the IRS is going to tax your net profit, not your withdrawals. Okay, so let's talk about the S corporation and that strategy now. So when you notice that your net income is continuing to grow, like I mentioned before, the benchmark would be $50,000. It's a good sweet spot to know that it's time to make a change or consult on it. Most of the time, I would consult people to become an S corp. There are times where I tell people to become a partnership with, let's say, a spouse or something like that. Or very rare to choose to be a C corp. It's very, very rare. But it's in general, it's S corp and at times a partnership. Now we're going to talk about the S corp because that's the majority. Those who do justify to be an S corp, so let's just say your net income is $100,000, right? $100,000. So you did $600,000 of sales, $1 million of sales, whatever it is. You have your cost of goods and expenses, and you're holding a net of $100,000. Okay, and you didn't take any official payment, or you didn't plan on it. What should you do? So number one, you need to take a reasonable compensation. So you need to W-2 to yourself something that's reasonable, that's going to be fully subject to tax. So yes, you had $1 million of sales, you took your cost of goods and expenses, plus all your spend anyway write-offs. You got it all journal entered into there. Now you need to take as well a W-2. And on that is what you're telling the IRS, here on this, I let you rip me apart, tax me away, payroll tax, income tax, federal, state, everything. So we want to keep that as low as possible. Right? The heavy income, the heavy payroll tax is like on the first 160, 170K. Right? That's where the main bulk of what's known as FICA tax hits. After that, it's a smaller amount, and obviously it still adds up, but the main hit is on the first 170. So obviously realize if somebody's going to tell you, yeah, you're making $1 million sales in business, take a $200,000 W-2, the savings isn't really there for you. The whole beauty is to keep your W-2 way less than the 170 to whatever degree possible. The question is, what's reasonable and justifiable? A lot of people think, oh yeah, reasonable comp. I need to see what someone in this position would do. And that's going to get you to a $200,000 W-2. If you want to hit those low numbers that we're talking about, that's something that I myself, my clients don't know how I figured this out for them. It's a mix of first seeing what's going on, what's their net income, how much distributions do they take in general, right? Like, what are we calling that they took a distribution because they spent it out of the business or transferred out of the business, and we can't call the write-off, right? If certain things you cannot, life insurance, you can't call the write-off, right? All those things, whether you transacted out of the business or transferred to your personal and now spent it from there, we see what those amounts, and then we come up with a percentage of that and call that. So we're taking, let's say you distributed $300,000 because that's what it takes to live. So $300,000, what percentage of that should we call W-2? And the rest will be called a distribution. Distributions are not taxed at all. right? Again, the net income is taxed, not the distribution. So the net income is 100,000. So what are you going to be taxed on? Your net income plus your W-2. That's it. That's it. So we want to try to keep. We can't call the whole $300,000 distribution and say that you're only taxed for income tax because on that 100K, because then you're completely avoiding the payroll tax, and the IRS is not going to be happy to see that. So you want to show them that, hey, you're following the game, you're following the rules. Here's your bones. Take your W-2 and give them something to chew on. You understand? So that's what you're going to do in the S corporation. You're going to break up the income to be taxed into those two levels, mitigate your W-2 as low as possible. So that's also a delicate conversation that I have with each and every client, figuring out. Now, sometimes it's too late, they didn't get W-2, so there's a way to backdoor it, and there's other strategies. And the point is that this is part of the method of being an S Corp and how to legally avoid you having to pay all that additional payroll tax, which you could easily have planned it to avoid. There's a lot of planning that is necessary to mitigate your tax. This is one important crucial detail. This is something that even my more simpler clients are doing tax planning with me once a year, just to ensure that if they're taking W-2, to take it in the most strategic way so that they're left with the best results, paying the least on payroll tax as well. So, we definitely could go into more details if someone brings something up on this in the Q&A. But that is the core idea of how you should pay yourself based on these different types of businesses, because these are going to be the main businesses that I would advise 99% of for-profit taxpayers to enroll into. So, you're going to start off either with no entity or a single member LLC and eventually evolve into a partnership or an S Corp, more likely an S Corporation. Right now, we could talk a little bit about the C Corp and the nonprofit a little bit. Sometimes I get clients who say, what about a nonprofit, especially in the therapy, healthcare? It's like, they're a sole practitioner, you know what I mean? But they it's so meaningful, the work, so that they can find a mission to call it a nonprofit. So I get these questions, or a C Corp, because they want to stay separate from the business, whether it's not to lose their benefits or whatever it is, right? So, and I told you, 1% of my clients, will opt in for that. Or it will make more sense for the meantime for them to do that. But one thing I also wanted to point out is that all this that we're talking about is for tax ramifications, not legal protection or privacy, because that's another confusion that I get from clients is, if you're looking to be legally protected from another partner or protect your property from a slip and fall, then having an entity have legal ramifications why you should want to have it. Nothing to do with if you're making income or not, that you want to have an LLC, right? And all the entities give you the same legal protection and privacy. It doesn't make a difference if you're a corporation, C or S or LLC. It's all going to give you the same legal protection. It's all about the legal documents. It's not about what type of entity you formed. The different types of entity only will influence how you're taxed, right? And we already came up and understood from the very beginning of our course that an LLC is not going to save you any more in taxes than being nothing at all or being a corporation. It's the same level of tax as being a sole proprietor, right? So that's a whole conversation itself. When I advise people to open up an LLC, if in the end of the day you're not looking for legal protection, you're not looking for privacy, you're not even going to save on taxes at this point, you're still small and simple,
But there's that middle path between small, simple, and becoming an S corp that I do say it's time to open up an LLC. So I just wanted to clarify. It's another thing that people, come across a lot with and confused. So one of the things to note when it comes to the C Corp and a nonprofit, why I don't generally guide my clients to have that is because when it comes to those entities, you can't just transfer to yourself and call it a distribution. It must remain in the corporation, or you must take it out in a way that's fully taxable, like as if you were on a W-2, right? So as a C Corp, that's what you do. You take a larger W-2, or call it a distribution, but the IRS is going to call that a dividend, and that's also tax. So there's no avoiding the tax over there. And with a nonprofit, if you're showing that you're taking large W-2s, it becomes, first of all, W-2 is not saving you taxes. If you're showing that you're taking large amounts of money out for yourself, then the whole point of a nonprofit is that you're redeploying the funds for the nonprofit mission. If you're the entire mission paying yourself, that doesn't qualify to be a nonprofit. So what happens is the people who I've seen come to me that were already C Corps nonprofits and have done so incorrectly, they're just living out of those entities, but they're not really proper write-offs that they're putting there. They just don't know what to do with the funds over there, and they gotta get rid of it. Okay, I see that we did hit that half-hour point, so I don't know if Yeshua wants to. I could continue going on before the Q&A, or if you want to just hop over to Q&A because I'm talking about extra stuff. Okay, I'll go on for a little bit more because I have another small section I wanted to say, and then we can go to the Q&A. Another thing that I've noticed is what happens is when you're going on payroll, so, a lot of these companies that do the payroll, they don't know how to nail and do the strategy properly. Either they're too big of a box company, like ADP or Paychecks, and they're going to try to work it out with them to get something favorable, or it's year end and you want to work it out. You have a change and you need an amendment, and it could be a headache to work with them. I typically recommend Friday, the platform. It's a company, I'm sure many of you have heard of it. There might be other companies like that. Lately, I've been recommending Friday. I know my clients have been very happy, so that's just something if you're considering to pay yourself and doing it S Corp and doing W-2, and you're finding holdbacks with these other companies, they're very accommodative with strategy. Another important point is when spending, on what's going on in your life and in your business, you should always ask yourself and think, is what I'm spending on now justifiable as a business expense? And if the answer is yes, start moving it over into your business. If the answer is no, then swipe it into personal. Now, I have a lot of times where clients are not sure or they think it's personal, and after a conversation, I'm like, oh, like their spouse's cell phone. They never knew how to make it. You gotta put them on the board of advisors, you gotta get your annual minutes. They didn't know what it takes to get it justifiable, ordinary, necessary. So definitely it's worth a conversation with your accountant. But the point is that you want to start thinking like that, because that's how you're going to be able to maximize the write-offs. It's like I would scan through your bank statements and credit cards, after this webinar, and see, hey, what am I spending on a month-to-month basis that should be transferred over to the business, and what am I spending on the business that should really be out of the personal, like let's say life insurance as an example I brought. All right. Well, at this point we are at the half hour, so I think if we could get some Q&A going, and one other thing I wanted to mention before the Q&A is that you can all join my newsletter. I have a weekly newsletter. You can sign up for it on eilenbergcpa.com. And of course, you could book a tax planning consultation whenever, now, later. Okay, and yeah, I appreciate each and every one of you joining. And we are ready for the Q&A. So I don't know how it works, everybody, but if you want to help guide on that.
Hello.
Yeah, hello?
Oh, hi, Yitzchok. My name's Romy. Thank you very much for the talk. It's a lot of very useful information. And I was going to say for myself, I'm a bit more kind of at the beginning stages, and I'm based in Israel.
Okay.
So I'm wondering in terms of how to structure certain things. So at the beginning, I probably won't be taking payment for myself anyway. But, in terms of the structure of, the Israeli system, I don't know if I know your expertise is very much in the US. Do you also have knowledge of the Israel system, and what could you share in terms
I
of?
have clients that are in Israel, but
Okay.
then I'm helping them with the American side of things to achieve the goals that we talked about. So, like somebody in Israel would be like, what should I open up? Should I open up an LLC, an S corp? Now, which state? Because they're not even in any state per se. Okay, so it's a first step to consider is which state is the best for you, because every state has different compliance requirements. Florida may be like, great, there's no state tax, but every year you got to pay $160 to renew your LLC. New York has state taxes, but they only charge you $9 every year to renew your LLC, right? And then on top of that is, and if you open up in New York, are you required, just because you have an LLC in New York, now to file a tax return in New York every year when you don't live here? What does tax filing follow? Where you open up the LLC or where you actually earn your income, right? So who cares that you open it in New York? Doesn't mean now you're required, so you must run to Florida. But that's a misconception that a lot of times clients come to me with. Yeah, we decided we're going to open in Florida because there is no state taxes over there, right? So that is something that you may have thought about, or people in the starting stages, eventually they learn that it's not like that. You know what I mean? But in the beginning, that could be a misconception.
Okay, so you're saying that's something to watch out for as well in terms of where you want to be based and looking into it further before just
Correct.
jumping into somewhere.
Yes, 100%. And then when it comes to opening it, so I just got on a call today with somebody, and they called me about opening up an entity, and they were wondering what's the right thing. So we do a mini consultation on that, and then after that, they're like, okay, they have many options on how to open it. Once they know exactly what's necessary, they can hire. I do it, but I know my prices could be steep, so they go to someone else, or they find an online option, or some people even just wing it themselves. And I've had clients figuring out how to do it themselves. Some succeeded, and some opened up the wrong entity or the wrong state and had to redo it again in the right place, and it ended up costing them. They didn't save, for sure. Didn't save. Maybe even cost them more.
Okay. No, great. Thank you very much.
Sure. Thank you, Avrami, for getting on and asking a question. If anyone else wants to ask a question and get some, direction or guidance, please unmute yourself and go ahead. And we'll take
Yeah,
your
hey,
question.
Yitzchok.
How are you?
How's it going? Good, thank you. Very enjoyable, very clear. Yossi Lasker here, by the way.
What did you say? What's your name?
Yossi Lasker.
Oh, yes, Alaska. Nice to meet you here too.
Nice. Okay, so just a question, follow up on what you're saying with regards to the S corp versus an LLC. Do you mind breaking down exactly you mentioned the 15 point whatever percent, the self-employment tax, the LLC. What does and I know that can be broken up with a spouse, if it's like a silent partner. What's the breakdown of fees you'd be paying the government with the S corp? So you'd pay, what would you be paying with the W-2 money? What would you be paying with the money left in the company? Or
So the 15.3% is only going to be subject and levied onto the W-2 that you take for yourself. So if you're an S corp, did $1 million in sales, as the example I brought, and you netted 100,000 after all your cost of goods and your real write-offs, and then added on top of that your spend anyway write-offs, right? And then we need to look to see with your distributions, which a distribution could be nothing to do with net income, because let's say last year you had net income retained into this year's. So you can have, let's just say, $300,000 to distribute in the next year while you only have $100,000 of net income. So we look at what your distributions are, and we also look at your net income. We put them side by side, and then we decide what's a healthy percentage of the two to take as a W-2. Now you may be like, how do you figure that before the year end? So that's why we do tax planning in November, when we have at least 10 months of results to do that analysis. And we say, like, okay, it makes sense to take a $30,000 W-2, $80,000 W. We figure out a good number. And we then we email the payroll company, which I said in this case, I've been working a lot with Friday. They really help out my clients is making sure they're doing the best strategy. 100,000, or we said, let's just say 80,000, 30,000. So let's just say until now they took 10,000 each quarter. They're like, okay, take another 50K the last quarter. And on that, they pay the payroll tax and all the tax or whatever it is. And then the rest, the net income, the 100K, they're only going to pay income tax. On the $900,000, which includes a lot of the spend anyway stuff, you pay zero. Now, there is on the business level in certain states a franchise tax, a very small percentage, and that tax has to be paid regardless of how much write-offs you take. The difference between a franchise and an income tax is income goes on net income, franchise goes on gross sales, top line. So if your top line is $1 million, you're getting a small percent tax on that, regardless of if you have a loss or net income. It's called a franchise tax. So I know New York have it, New Jersey, Texas, and clients that have in many states. Even Texas, for example, which you know will be a tax-free state, but when it comes to franchise tax, they have something if you have over a certain amount of sales. So I hope that answers the question, or you could go into more detail.
So where does that money that doesn't go towards the W-2? That has to stay in the company, but that could be withdrawn, but not under the W-2.
Right. So your clients are paying you, your bank account is building. You're spending on the business. And then you start to go over all your spend anyway stuff, and you start transacting that out of the business throughout the year. Just make sure you got the justification for it, whether it's having board members, board of directors, board of advisors, annual minutes, electronic proof of the payment, receipt, if you need to have also a letter or like an agenda, like they say, if you're going out to a restaurant, who did you speak with? What did you speak about? Which I like to just do everything on my Google Calendar, just have all the list over there. So you just want to make sure to have the legal documentation too. But yeah, and then that's basically how you get all the money out of your business, through your spend anyways and your W-2. Between the two, we get everything out. And if a person needs more, then there's more strategy. There's kids on payroll, and there's some other strategies that we are able to, help them with. Sometimes, there's more advanced stuff that you could employ as well, like whether it's charity strategies and other things. But typically, with the strategies that we talked about today, we're able to do pretty amazing stuff.
I see. Okay, thank you.
All right, appreciate that, Yossi. Thank you for hopping on and asking a question over here. We're still on for the Q&A, so if anyone wants a chance to ask for any direction on paying yourself, taxes, feel free to come on live and ask a question and get some answers. Well, it doesn't seem like there's anyone else who has questions, so I'm happy to know that we resolved everyone's questions who showed up today. And there'll be a recording going out, like Yeshua said. He said he got stuck on a call, so he wasn't able to join for the Q&A. So I'll be wrapping up here with the final words and wishing everyone a great rest of your week. And again, thank you, everyone. It means a lot to me that each and every one of you joined, and I hope that I was able to deliver high quality value and didn't let you down with today's webinar. Thank you very much.
Thank you.